Stocky, I've been long-term holding NVIDIA for a while. Don't care to sell and never really check the price. But seeing NVIDIA at 4 trillion is actually kind of crazy. What are your thoughts on 4 trillion companies in 5 years? Will there
I
be
mean,
more
here's
or
the thing,
less?
you know, if you take into account that the dollar's been getting killed, you take into account into inflation, that offsets some of that. On top of that, the amount of money that's piling into the market domestically and internationally and from retailers just keeps pushing everything up. Is 4 trillion insane? Yeah, but what if you're looking at 4 trillion based on what 4 trillion was 10, 15, 20 years ago? I mean, that's like 2.5 trillion if you take into account inflation, right? We don't take into account inflation. So if you look at the company's market cap, but you look at, you know, the valuation of the dollar, it's not the same. It's not the same. Again, I think it's insanely valued because people want to be a part of that future and who knows what happens. But again, you have to take into account a lot of things. Massive more amounts of money flowing into the market, internationally and retail side. You've got the fact that the dollar's down big time, inflation's up, so valuations are offset by that as well. So I mean, it's really hard to look at it in that scope and be like, yeah, that's you know, too high. Remember also, something is not worth what you think it's worth what people are willing to pay for it. And if people are willing to buy it at that valuation, that is what it's worth. I mean, it's just what it is. You know, book value versus what other people are willing to pay for it. And here's the thing. Do you think it's overvalued? Great. But does that mean it's not going to continue to go up? Or do you think it's going to crash? Okay, let's say you think it's going to crash. What will be the catalyst for people to sell? It's not firms. Firms don't have the control anymore. Look at me. We are the captains now, okay? Individual firms used to have the power. If they wanted to dump a position or clear something, they would sell. It could cause others to sell. It could cause capitulation. It could do that. That doesn't happen anymore. Why? Because retail investors are dumping $5 billion a day into the market. Not only because of dollar cost averaging and 401ks and IRAs, and 62% of Americans have stocks now as opposed to 45% pre-pandemic, but you've got retail degens that are buying dips, selling rips, and have money on the sidelines that buy it up. So before, they would sell it knowing that would cause more selling to happen. Now if they sell it, someone else is buying it up, and now they miss out. So even firms now are having to rethink how the market has changed. So the question is what is going to cause retail and everyday investors to pull their money out of the U.S. market? In my opinion, that is people, when we see more and more people unemployed. While unemployment is high, it's not insanely high right now. Plus, the amount of people that have so much equity tied up in their homes can borrow against their homes before they touch their equity. So there's no real catalyst for people to actually sell off their equities to live off of or whatever. So you got to ask yourself then, what becomes the catalyst? Could be a trade war, could be a tariff, could be a GDP print, it could be recession indicators, it could be that. But how long will that last as well, right? Look what happened with the tariffs. We were buying the hell out of the dip in April because we knew that wasn't long term. Nothing was irreversible, and it wasn't going to destroy our economy in the long term. You know, even if it was a big problem for a couple of years, it was not irreversible. So you know, we bought into that. That's the question. So that's why whenever we see sell-offs and short-term bearish sentiment in the market, I'm like, okay, cool, but is this a 20-year thing? Because remember, most people that buy into the stock market in their 401ks and IRAs don't look at it on a day-to-day basis, or they don't know what the data means. They don't pay attention to what the interest rates are today and what China did overnight. They don't do that. They just set up their buy, right? And if there's so many more people doing that now, then they're not panic selling or doing anything like that. They're only going to tap into that equity, those equities, if it's the last resort, and that would mean long-term sustained unemployment for a large portion of the population. That not only that, but that are exposed to the stock market, right? Your average gig worker isn't as exposed to the stock market. But as we see more tech layoffs, that could be a problem. So that's something that I pay attention to. The one stat that I pay attention to that most people don't is the average hours worked. I think that's a huge recession indicator that nobody talks about. Now, does that mean that I know when the market's going to go up and down? No, I don't. You know, I just buy the dips and I hold it because my thing is the market's going to continue to go up until it stops going up. And when it stops going up, well, I have bigger problems than what my fucking 401k or IRA has. You know what I mean? How do you track that? So we have... because here's the thing, layoffs happen. There's surges in hiring. There's layoffs and happen stuff like that, and that's part of the thing. Now, massive, widespread, long-term layoffs and job cuts are a big deal. But the way that I focus on, one of the indicators I look at for recession is at least a recession that because remember, they changed the definition of recession in 2022 because we had 2 quarters of negative GDP, but unemployment was still low. So they said, well, technically we have to rename a recession because it's not a recession because it wasn't GDP and higher unemployment. But what I look at is not how many people are working, but the people who are working, what is their average hours worked? Because if you're going into recession, they start cutting the hours worked per employee, not just the amount of employees.
Welcome, Jerris
So this is the last report here.
to the Bear Gang.
As you can see right here from the Fred data, average hour, weekly hours of all employees. We saw, obviously, after 2008, right? We saw this huge dip here. 2020 with COVID, we saw a huge spike up here after the post-COVID boom, but we're right back down to the median right here where we were. And so it's down right now, but it's not continuing to dip. We've kind of shelved at 34.2. If we go under 34, I will be concerned because I'd prefer to see it at 34.5 because that's kind of the median here, and that's kind of like healthy timelines here. This is like I said, this is from the COVID the post COVID right here. It's shelved at 34.2 to 34.3, but if we dip below 34, then I'll get concerned as far as like a big recession indicator. Bro, we are at COVID levels. Well, yeah, COVID was 34.1, but the reason that it was it dipped was because there were so many people laid off or furloughed that they didn't count. And we actually saw a increase in hours worked for the people who were working because it was nurses and first responders and healthcare workers, and they were working more. So this is, you can't really count COVID because there was a huge offset. It should have been much lower than that, but because there were so many people not working and the people who were working more hours than normal, it kind of gave a higher rating and reading than you would expect. Grocery store, yeah, stuff like that. Again, that's just my opinion. Okay, that's just my opinion. I'm just one idiot on a gaming site with a camera. I mean, don't listen to me. I'm just saying that something that I focus on is stuff like that. That's kind of how I like to look at it and say, okay, are we shelving? Are we steady here? You little spikes here and there, but do we have a pretty decent median? And coming out of 2023, we did dip back down here, but we have shelved. And so I'm kind of like looking at this and saying, all right, we have more gig workers than ever, so this kind of offsets a little bit, but is this steady? If this starts to decline again, then I'm going to get really worried because then we're going to push down. What's your outlook for the FOMC tomorrow? I have no idea. I am not a fan of a jumbo cut right now, but I do think that they are going to signal more cuts. I think they go 25 basis points, but they signal potentially 3 to the end of the year or bring the terminal rate down. That's something I'm looking at potentially. I have this weird feeling, and I could be completely wrong, but I have this weird feeling that we're going to have a bloodbath on Wednesday when Powell takes the stage. I don't know, but 17 out of the last 20 times we have had a rate decision and Powell took the podium. From the time he took the podium at 2:30 to the end of the day, we have dropped between 1% and 2% from the time he took the podium to the end of the day. 17 out of 20 times now. The question is all this liquidity that's pushing in for the rate cuts, once we get that, is that liquidity going to be used to take a little bit out of the market? Because expectations are there. We've kind of priced it in. It's all about what the forecast guidance is and what the Fed is seeing. And a lot of this wishy-washy of like, hey, here's the problem. You're cutting rates into an inflationary environment. Why? Because the labor market's getting crushed. So now you have to cut rates into an environment that's inflationary, that's gonna push inflation up in order to stop the bleeding on the labor market, because that's harder to fix than inflation. So we're in a weird fucking problem right now. We're in a weird situation right now. This is the definition of stagflation, right? And the Fed is going to have to find a way to cut rates to slow down the bleeding of the labor market while not driving inflation up massively. And the reason is that people forget that there are a lot of people struggling in this country, but a lot of people are doing better than ever. The top 40% of people are doing really well. Okay, the bottom 30% of people are doing worse than ever, right? And then you've got that little middle ground. And 40% of earners in America account for 60% of all spending. So if you lower rates, those people are going to be able to spend more, which drives up inflation. But it also drives up employment, because if you're now able to finance a boat or a car or a house or whatever, that's going to cause job creation, right? So you do get more jobs, and it does help slow down the labor markets, bleeding out, but it also drives up inflation. So it's like, where are we going to end on this? This is a really bad spot to be in. If we were in if inflation was slowing down or flatlining right now, I wouldn't be as concerned. But the fact that we're seeing CPI prints come in at 2.4%, 2.5, 2.6, 2.7, 2.8. We're still under that 3% because the Fed has given up on their 2% mandate. Okay. The Fed has legitimately given up on 2% target for inflation. They're just like, fuck it. You know what I mean? Like, all right, guess maybe 3%. So we're already going to 3%, and we're going to have to cut into that and potentially do multiple cuts into it because the labor market is soft right now. Yeah, they've basically gone to 3% instead of 2%.